The quality and value of what customers get for their dollar these days has regressed across the board. Yet it's customer experience that has suffered most, as the basic core services like support and checkout have all been ripped up so companies can try to make more money with less. When you shop at any retailer or supermarket these days, you'll find yourself generally funneled to self-checkout, where you're stuck watching people in front of you awkwardly fumble finding barcodes, bagging their own groceries, and panicking whenever the machine shouts at them or the screen freezes. There's usually only one worker who's overseeing everything, and whenever a problem occurs, everyone has to wait on them for a resolution, all of which translates to a longer wait time, higher margin for error, and frustration. To add insult to injury, you had no choice in any of this as a consumer. Even if you wanted to go back to the normal checkout aisles where a cashier scans and bags for you, you can't, because those aisles are either closed or they're so short-staffed that the lines there are even longer than those at self-checkout. All of this tech suddenly appeared nationwide in the mid-2010s. Since the debut of self-checkout, retailers from Kroger and Walmart to Target and Home Depot have all publicly gaslighted that self-checkout is faster and that these machines are not there to replace workers, but to instead free them to be more productive. They stuck to this script year after year despite the continuous backlash and disapproval, and their stocks collectively grew as Wall Street applauded these investments, believing that tech innovation would unlock unprecedented efficiencies and profits for these age-old, overhead-intensive businesses. Fast forward just 5 years, and self-checkout has largely been a flop. Most retailers have backtracked, ripping out their machines and going back to human cashiers. While a few chains have continued to gaslight that self-checkout is still the future, the reality is that even they are scaling back, restricting the conditions in which consumers can use these machines. Self-checkout has been a flop not just in the US but also overseas, and all of these retailers are hoping to sweep things under the rug while the market obsesses over AI. Ultimately, the retail industry is just as confused as everyone else, as there's been no clarity in the data. Is getting rid of a few part-time cashiers making $10 to $15 an hour actually even meaningful business-wise if you're spending millions of dollars on loss prevention, security, and self-checkout technology? Did retailers who installed self-checkout machines end up saving more money or improving their profits? And how did such a conservative, disciplined industry get caught up in this hype? What does the future hold in business? Ask 9 experts and you'll get 10 answers. Analysts will say inflation is down 1 month and then up the next. It's the same constant whiplash with unemployment, jobs reports, and the health of the economy. Could someone please invent a crystal ball? Until then, over 41,000 businesses have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP bringing accounting, finance, inventory, and HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. When you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. Modern MBA is small at the moment, but as soon as we scale, we'll need and use NetSuite. Today we're stitching things manually, and it's gotten harder to assess our business health. We need to track production costs, to run payroll compliant with multiple states, and to evaluate profit and loss by team and project. As a corporation, we pay tax throughout the year, and it's a nightmare jumping from system to system just to get one answer. These are capabilities that only NetSuite provides, and it's a platform that we intend to take every advantage of. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/modernmba. The guide is free to you at netsuite.com/modernmba. netsuite.com/modernmba. Retail is a tough industry. It's a capital-intensive, high-overhead business where even the giants squeeze out 4 to 8% operating margins a year. Whether it's peddling fresh produce, daily essentials, or cheap toys, retail generates incredible cash flow as the industry leaders gross more in a single year than even the big tech companies. But gross earnings are not the same as net. 60 to 70% of every dollar that a retailer earns goes to buying products. Even with economies of scale, the product costs for the leaders with the best volume and the greatest wholesale discounts like Walmart and Costco still end up in the 60 to 70% range. If anything, their product costs are generally higher, as these giants have to spread themselves thin to carry something for everyone. On the flip side, the more specialized a retailer is, like in home improvement or in organic produce, the lower their product costs will be. But once again, they're still in that 60 to 70% range. With only 20% gross profit left after paying for the goods and getting them delivered to the stores, retailers have to clamp down on everything else to squeeze out profit. They generally hire low-skilled workers at minimum wages, pay below market rents as anchor tenants, control hours, and rely on part-time seasonal staff to stock shelves, handle sales, and maintain the space around the clock. For every dollar that retailers earn, they generally spend another 15 to 30% on labor, which leaves an operating margin of just a few single digits. There's little profits in this line of work, and it's been this way for decades. With tiny margins and high overhead, retailers by nature are conservative, careful, and frugal. There's no such thing as fast growth in this industry. They don't have the margins to make moonshot bets every quarter, and they have to be financially disciplined with their asset-heavy, people-intensive volume model. As a result, retailers excel as defensive, reliable investments. But in the zero-interest environment of the 2010s, investors wanted upside, not security. It was in this period when tech companies skyrocketed, as their stocks consistently outperformed those of any other industry year after year. Even though most tech startups lost money, their fundamentals compared to retailers were incredible, with massive 70% plus operating margins. Tech was the exact opposite of retail. In the early 2010s, every retailer focused on the same strategies. Their goal was to open up more stores, to add loyalty programs, to expand product variety, and to drive more in-store traffic. Consumer confidence was fragile exiting the Great Recession, and retailers were focused on getting them back in the door and spending. There were no grand speeches of innovation or radical ideas about the future. But everything changed in 2016. Suddenly, every retailer overnight began talking about automation and technology. Despite having zero issues with it before, the checkout aisle became the industry's public enemy number one. This was the Amazon effect. It was in 2016 when Amazon launched its futuristic store, where customers could walk in, take the items they want right off the shelves, and walk right out. With computer vision, deep learning, smart sensors, and the same autonomous technology that was fueling the self-driving and IoT hype at the time, Amazon boasted that it had revolutionized retail by opening the first store in history without checkout. Customers would never need to wait in line again. Labor costs would be dramatically lower, as this technology would directly replace cashiers and checkout aisles. Everything was automated, and these stores only needed 1 or 2 workers on hand to restock shelves as needed. In this fast-growing era of on-demand digital everything like Uber and DoorDash, it wasn't a stretch to imagine that customers would be willing to pay a greater premium and spend even more with such extreme convenience. And from the business side, what had once been an unavoidable, error-prone variable cost could now be eliminated permanently with this one-time investment in hardware and software. Given Amazon's track record, the media hype, and the all-time high positive sentiment towards tech, the public believed every word out of Jeff Bezos' mouth, even though the first store was really nothing more than a proof of concept. Retailers overnight got spooked. If Amazon opened up more of these stores, it would be hard for their customers to go back to waiting in line at their stores, and they would look like dinosaurs in comparison. At the same time, there was no way that a retailer could ever catch up to Amazon's engineering talent. There was some initial speculation in the industry that Amazon Go was just a testing ground, and that Amazon's actual goal was just to eventually license out this tech to these retailers for a fee. But those hopes were dashed when Amazon suddenly acquired Whole Foods a year later. Whole Foods provided a huge customer base, supply chain, perishable expertise, and a nationwide presence, and Amazon could embed its technology and aggressive Silicon Valley data-driven approach into retail directly. With a purchase price of $14 billion, the biggest acquisition to date in company history, it was clear that Amazon wasn't going to settle for being a back-end software vendor. Jeff Bezos had killed off bookstores before, and he was now taking on supermarkets head-on. There was no one else in the world more qualified and more committed to disrupting the remaining retail giants. 8 years later, we know now that the supposed groundbreaking technology behind Amazon Go was not actually real. All Amazon had done was to replace local human cashiers with 1,000 remote workers in India who had to manually review the footage to see what items customers actually picked up and walked out with. 7 out of every 10 transactions needed to be manually verified by this remote team, meaning only 30% of the sales were actually automated. Beyond the issues of accuracy, the technology from the lens of hardware and software was not actually scalable. A single Amazon Go store required thousands of state-of-the-art cameras and fiber internet. Amazon has since quietly retreated back to conventional checkout and local human cashier for Whole Foods and for its own stores. And in the past year, they've laid off hundreds of employees from its Amazon Go teams, closed down the vast majority of its stores across the US and Europe, and ripped out the cashierless just walkout turnstiles in Whole Foods. But back in 2016, no one had any idea at the time that Jeff Bezos was just blowing smoke. It wasn't just retailers who were spooked, but also Wall Street who began demanding answers. For better or worse, Amazon had become a forcing function. They had established a standard and identified a specific area for automation that everyone else in retail needed to live up to. How would the industry leaders like Kroger, Costco, and Home Depot compete with Amazon's new, people-light, high-automation stores? Could they ever transition to make their checkout self-service just like Amazon Go? And within a year, self-checkout became priority number 1 for the entire industry. It was a gold rush without the gold. For leaders like Walmart, Kroger, and Target, they were eager to demonstrate that they weren't actually dinosaurs waiting to be disrupted, but instead equally capable of adapting to the latest trends and creating their own proprietary technology. In return, they could maintain their valuations and grow the appeal of their stock in what was a tech-dominant market. Yet retailers of all sizes were under pressure to show progress towards self-checkout. Smaller chains like Dollar General and Sprouts didn't have the war chest of a Walmart or a Kroger to throw millions of dollars hiring engineers and building machines. They also didn't have the incentive or the urgency to reinvent themselves in the eyes of Wall Street as some progressive, modernized corporation. They only needed to reach this bar, not exceed it. Ultimately, the clock was ticking, and the industry as a whole needed to get self-checkout up and running ASAP to remain competitive. They would never be fully automated and entirely cashierless like Amazon, but if they could get customers to scan and bag their own groceries, if they could start removing the existing checkout aisles and start hiring less cashiers, then everyone would in theory be closer towards realizing this future. The fastest option was to outsource, and there were two companies who were eager to provide the hardware and software shovels for this faux gold rush. ATMs were the earliest and most successful example of retail automation where customers could self-service themselves on machines and banks in turn could hire less tellers. In the US, there was NCR, and in Europe, there was Diebold Nixdorf. Both companies made their fortunes building and selling ATMs to banks. But there's only so many banks in the world who need ATMs, and so much innovation to be had with cash withdrawals and check deposits. By the late 90s, the ATM market had been completely saturated. As a result, growth was slow through the 2000s, and both companies desired to introduce self-service to other industries. Places like airports, car rentals, concerts, and hospitals were all opportunities where staff could be easily replaced with a machine. But NCR and Diebold were only vendors and suppliers. They could only follow the wind, and most retailers were not willing to risk the resources necessary to undertake a project of this scale. NCR settled for DVD kiosks, believing that they could fill the hole in movie rental with Blockbuster's bankruptcy, but all of that went up in the air with Netflix and streaming. Earnings fluctuated for both companies through the 2000s as the company struggled to find growth beyond banking. Despite grossing billions of dollars a year, there still isn't a lot of profit in this line of work. After designing the machines, outsourcing the manufacturing, writing software, and maintaining the hardware at scale after deployment, operating margins for both NCR and Diebold were as low as the retailers themselves. The first real win came in 2012, 4 years before Amazon Go, when NCR won an initial deal with Walmart, who had the capital, incentive, and interest to pursue self-checkout. Walmart, through history, has been aggressively anti-union, and its executives were always upfront about exploring ways to cut hours, eliminate workers, and to reduce overhead. But as mentioned before, the rest of the retail industry wasn't convinced that these investments were worthwhile or repeatable at a smaller scale. And all of that changed in 2016 with Amazon Go. Suddenly everyone wanted self-checkout, and it became NCR and Diebold's fastest growing division. Diebold's retail business doubled in a single year, and for NCR, that growth was channeled across multiple years as it took longer for the deals and deployments to materialize. Like any good shovel seller, both companies openly fanned the flames to drive urgency. They proclaimed that their machines were necessary to winning the next generation of shoppers, that millennials loved self-checkout, and that stores would be radically transformed in their layout. And the best part was that these self-checkout machines could be productive 24 hours a day, whereas a human could only work 8 hours at most. Everyone knew that NCR and Diebold would never match Amazon Go, but at the very least they were the cheapest and fastest option. But even though demand and sales grew rapidly, not even the shovel sellers were profitable. It was a fake gold rush, and both NCR and Diebold actually lost money every year as they burned millions of dollars into R&D and sales, believing that this short-term investment would have long-term returns. They never imagined that Amazon and the industry would do such a massive U-turn, and that retailers would now go so far as to rip out their deployments with the sunk costs. The other issue is that NCR and Diebold's machines were always designed as a one-size-fits-all solution. They were ultimately chasing a future that had not been proven. Thus, while their machines excelled at replacing simple, sequential workflows like checking into a flight or printing a boarding pass at the airport, self-checkout was a beast of its own. Every retailer has hundreds, if not thousands, of different SKUs that change regularly, along with their own systems, programs, catalogs, and policies. These machines needed to be able to follow all of these things and to be updated whenever these items changed. But given the rapid speed at which retailers adopted, purchased, and rolled out these machines, it was all trial by fire, and NCR and Diebold needed to provide even greater support, support, maintenance, and services post-sale, all of which chewed into their profits. Revenue has regressed as their customers have generally churned or opted to maintain their installations instead of expanding. And their stocks have fallen as both companies find themselves in the same situation today that they were in 10 years ago and 20 years ago, looking for growth beyond ATMs. Walmart was the earliest and the most aggressive, having invested in self-checkout technology long before Amazon. Without any unions to slow them down, they were the most capable and ruthless of all retailers. In 2017, the same year in which Amazon purchased Whole Foods, Walmart had completed rolling out self-checkout in every store. Their goal was to eliminate workers entirely, and there was no gaslighting about a better customer experience. Quote, self-checkout at the front changes the labor model dramatically inside the store. Our focus is really on changing the work. When you change the work, you can create leverage inside the profit and loss versus us just cutting hours because that's a short-term play. But when we look at the hard numbers, it's not clear at all that the removal of human cashiers has netted any meaningful benefits to Walmart's fundamentals. When we look at the average number of hourly employees per store, there was a brief period after the standardization of self-checkout where the company did hire less workers. But these days, Walmart is actually hiring just as many people per store as it was before self-checkout. And that's strange because there's actually fewer Walmart stores these days than there were a decade ago. If you're only keeping your highest performing, most productive stores, on paper you should be hiring less people to operate these assets that you know very well. When we isolate labor costs and we look at SG&A as a percentage of revenue, we actually find that Walmart is spending even more than before on labor and administration. Even if they're not hiring more hourly workers than before, they're spending more dollars on support, services, and machines from NCR and greater corporate headcount. And since we know that NCR itself as a company is not in a healthy position, the idea that the cost of self-checkout will simply flatten out over time in the near future seems foolish. NCR has to make its own money, just like Walmart, and if they remain stagnant too long commercially, they'll eventually come to demand higher prices. Profit margins for Walmart have actually decreased after the standardization of self-checkout in 2017. While inflation is one potential explanation for the lower profits, the numbers don't really suggest that, as the cost of sales as a percentage of revenue has grown slower than the cost of labor and administration. Even if Walmart is not hiring more cashiers specifically, the point remains in that the overhead is higher than ever despite running fewer stores and without unions. Just in the past year, Walmart has ripped out self-checkout in select stores, returned to the conventional aisles and human cashiers, divested many of the tech ventures that had started to better compete with Amazon on the side, and cited the need to return to basic, human-friendly service to grow profits. Besides Walmart, we can also look at other big grocery chains like Kroger and Albertsons. The difference is that Kroger and Albertsons workers are unionized and thus enjoy stronger protections, better benefits, and higher wages than those working at Walmart. While Walmart publicly talked about their desires to cut workers outright, Kroger and Albertsons could not because they had to maintain a positive relationship with their unions. Instead, they talked up self-checkout as a way to improve customer experience. And Kroger, like Walmart, wanted to show to Wall Street that they too were capable of innovation, and they pushed the notion of self-checkout to even greater heights. As a direct response to Amazon's technology, Kroger rolled out Scan, Bag, and Go, where customers could use their phone to scan products, put them in their bag right afterwards, and then walk right out. By 2018, self-checkout had been installed in every Kroger store, Scan, Bag, and Go was available, and the company boasted that they had unlocked massive double-digit productivity increases in all of their stores. Hilariously, Scan, Bag, and Go was quietly killed off in 2022, lasting just 4 years after its launch. Like Walmart, there's been no change in the number of hourly workers per store before or after the implementation of self-checkout. There may be less cashiers, but not less staff. And the lower operating margins have nothing to do with inflation. Kroger's product costs as a percentage of revenue are actually lower than what they were a decade ago. Labor and administrative costs, on the other hand, are actually higher than ever and have been for the past 6 years, despite the company forcing self-checkout on customers. Kroger to this day continues to gaslight that self-checkout is the future and that it provides a better customer experience, despite the reality that the company's operating margins remain at their lowest. Albertsons has also hired on average about the same amount of workers per store before and after their implementation of self-checkout. Labor and administrative costs have certainly improved after, but that can also be attributed more to the continuous layoffs at headquarters and store closures. Sprouts has opened up more stores year after year, and the numbers demonstrate that they've hired fewer workers since their implementation of self-checkout in 2020. Yet at the same time, despite hiring less people, labor and administrative costs have actually increased. Overall operating margins for Sprouts are lower these days than what they were 5 years ago before self-checkout. And once again, it has nothing to do with inflation or product costs. It's been the same case for even the discount stores like Dollar General and Dollar Tree. Dollar General did not implement self-checkout until 2019, and their labor and administrative costs have remained the same in the years after. The company spent millions of dollars installing self-checkout machines, only to discover that removing human cashiers dramatically increased shoplifting. Dollar General had always run its stores with a skeleton crew to cut on labor costs, but now with self-checkout, they had removed the human at the front. And without a staff member at the front to deter stealing, opportunistic thieves were walking through self-checkout with bags of stolen merchandise without consequences. Everything came to a head in 2024 when profits plummeted to a 16-year low over the rampant shoplifting, and Dollar General responded by killing off self-checkout entirely. They've ripped out the machines at most stores, restored the checkout aisles, and invested more into human cashiers and staff, with SG&A at an all-time high. And on a per-store basis, Dollar General is now hiring more people than ever per store in company history. It's the same situation with Dollar Tree, who is now spending more than ever in labor and administration in history to deter the theft at self-checkout. Despite rolling out self-checkout in 2017, Target these days has more hourly workers per store than it did a decade ago. Labor costs as a percentage of revenue has remained virtually unchanged for the past 10+ years, and annual profit margins are any better today than they were back in the early 2010s. The only exception to date has been in home improvement, where Home Depot and Lowe's have both reported a decrease in labor costs since their respective implementation of self-checkout. Their annual operating margins have also materially improved. There's a couple factors as to how this could be. One is that theft at self-checkout is generally a crime of opportunity, meaning that people either intentionally or accidentally forget to scan something. With home improvement, the high-value items are generally so big and so bulky that that kind of theft would be impossible to hide, and the higher-value, smaller products are already under lock and key or already under added surveillance, meaning the opportunity for theft is just that much lower. The product value and order sizes at home improvement stores are also substantially greater than that of supermarkets, and chains like Home Depot and Lowe's have already sunk millions of dollars over the decades into loss prevention, whereas the grocery chains are just now starting their own investments. While there are some who assert that the failures of self-checkout are cultural and psychological, it seems obvious that technology and machines have a long way to go before they can replace humans. Even the ones that corporate America deems to be the most useless and replaceable, scanning groceries, packing orders, and talking to customers for $10 to $15 an hour.